Ziff Davis Inc., NASDAQ, ticker ZD. This is a quick fundamental snapshot of the company, where it stands financially, and what's worth watching heading into the rest of the year. Ziff Davis is a vertically focused digital media and internet company. It owns well-known brands like CNET, PCMag, IGN, and Everyday Health, spread across 5 segments: technology and shopping, gaming, health, connectivity, and cybersecurity and martech. Revenue comes from several sources at once: advertising, subscriptions, affiliate commerce, and licensing. At a glance, shares trade around $55.50, giving a market cap near $1.94 billion. The stock carries a PE of 48 times earnings against a book value of $64 a share and diluted EPS of $1.15. On profitability, operating margin sits at 12.6%, but net margin drops to just 3.3%, so there's real drag below the operating line. Return on equity and return on assets are both modest, at 2% and just over 1%, showing a thin earnings base relative to the company's size. The balance sheet is the strong point. Total assets sit near $4 billion, with $1.6 billion of that in cash, about 40% of the balance sheet. Debt is moderate too, at a debt-to-equity ratio of 0.39. This is a conservatively financed company, not one leaning on leverage. On scale, annual revenue lands around $1.45 billion, but net income is just $47 million. Put simply, about $32 of revenue turns into $1 of profit, a thin conversion rate, typical of ad-heavy media businesses. Looking at the most recent quarter, advertising and performance marketing, still about 61% of revenue, declined 5% year over year. But subscription and licensing revenue grew nearly 2%, a small but meaningful shift toward more predictable, recurring income. Here's the tension in the valuation. On earnings, the stock looks expensive, 48 times PE. But on assets, it trades below book value at 0.87 times. A rich earnings multiple paired with a cheap asset multiple and a low return on equity suggests the market is betting on a recovery story that hasn't shown up in the numbers yet. Strategically, Ziff Davis is reshaping its portfolio. It's agreed to sell its connectivity segment, now classified as discontinued operations. It's holding roughly $520 million in cash to support that transition. And management is leaning into artificial intelligence and off-platform monetization as its next growth levers. The risks to watch: heavy reliance on advertising, a thin margin cushion, modest returns on capital, a valuation multiple that's ahead of current performance, and execution risk as the connectivity sale plays out. So the takeaways: a diversified but still ad-dependent business, a genuinely strong balance sheet, a valuation that's pricing in more than current returns justify, a subscription trend worth tracking closely, and a company actively reshaping what it will look like going forward. Data pulled from SEC EDGAR filings and the company's Q1 2026 results presentation. And to be clear, this is an informational overview only, not investment advice. Always do your own research or talk to a financial advisor before making any investment decisions.